Central banks have been raising interest rates sharply over the past 12 months to fight inflation. This has contributed to recent volatility across the financial sector as the effects of tighter monetary policy filter into markets and the economy with a lag. Peak policy rates are now likely to be lower than market previously were pricing, but normalizing monetary policy and then eventually easing will take more time and need inflation to decrease closer to target levels. In the meantime, unemployment is likely to rise. Broadly, we believe bonds continue to look attractive at current yield levels, offering a balance between income generation and cushion against potential economic downturns. During this part of the economic cycle, we prefer higher quality, more liquid investments and are avoiding lower quality, more economically sensitive areas that are most exposed to the effects of tighter monetary policy. We are starting to see more attractive opportunities in newer deals within private market, but prices of existing assets have been slower to adjust compared with public markets. In a world of higher funding rates, forced deleveraging is likely. Bank failures, wider elevated volatility in bank stocks, rising cost of capital, and ongoing potential for deposit flights from more fragile small and mid-sized U.S. banks all suggest that credit conditions may significantly tighten, particularly in the U.S. These events will likely lead to an earlier recession in the case of the U.S. and act as yet another headwind that could very well pull Europe into recession as well. We think the risk of a deeper recession has gone up since banks, even large so-called national champion banks, may retrench and shift their operation to a more conservative approach. Still, there are good reasons to believe that this is not 2008. Households still have excess saving, aggregate corporate debt to GDP ratios appear manageable, and so far, bank losses have mostly resulted from rising interest rates, not from risky lending or credit defaults. The largest U.S. systemically important banks remain financially sound and have been the beneficiary of deposit outflows at smaller banks. Improved valuations and greater certainty in the capital structure reinforces our bias for senior debt over subordinated bank issues. All of this means central banks likely need to do less heavy lifting to get to the same result. Tighter financial conditions, which slow down credit growth, demand, and eventually inflation. Wages and in turn services inflation are likely to moderate more slowly and will feature in how the Fed assesses the trade-off between financial stability and inflation risks. With China's faster reopening and the smaller extent of tightening that has taken place across many Asian economies, we see fewer macro headwinds for the region on a relative basis. In fact, recent credit events in US and European banks may lead to a less hawkish stance by the Fed, such that Asia central banks can act according to their respective economic circumstances. The Asia banking system overall should be in good shape, reflecting a tight regulatory framework with strong capitalization and less reliance on wholesale funding. While global credit sentiment may have weakened from recent events, issuers in Asia may be able to take advantage of the access to onshore lending while liquidity conditions remain sufficient, notably in India and Indonesia. We see an earlier than expected economic recovery in China, and the extent of the upside will depend on the rebound of consumer confidence and deployment of excess savings. Growth support will be driven more by consumption than property or infrastructure investment, following on from the sectoral rotation from 2022. We see pockets of opportunity in select Asia financials and in corporate credit across investment grade and high yield, while noting that market volatility will likely remain elevated.